Hey Bowtie Nation, Joseph Hogue with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. Nation, the internet as we know it is on its last death rattle. The internet you're used to staring at a screen is about to change, replaced by voice-driven interaction, a trillion-dollar opportunity built on AI, and I found 5 stocks you need to buy to be ready. Stick around and I'll also update you on stocks I'm watching this week, including Salesforce and Broadcom, along with the update to our stock market outlook. But first, big news for the Bowtie Nation, something I've been wanting for years. YouTube has now rolled out community posts in the community tab on mobile. If you go to the channel on your phone, scroll over to posts, and then to visit community, you're going to be able to post your own questions, comments, and picks as well. This has the potential to really keep the conversation going from the video, so post your questions, your stock ideas, your screenshots of your investing journey, anything you want to share with the Bowtie Nation. Now, one thing, only subscribers can post right now, so make sure you tap that sub button and join the community. Back to our main topic though, and in 1995, there were just 9 million US internet users, about 3% of the population. Today, that number is closer to 320 million, or about 93% of the country. In that time, Microsoft and Apple have grown up with the digital revolution, with shares up as much as 66,000%, 665 times your money. Nvidia and Amazon weren't even a thing yet, but both have made billionaires of early investors. Now, 30 years later, the internet as we know it is about to die. In its place is going to be a completely new type of digital experience, and it's not going to take 30 years, but maybe 3 to make millionaires of the investors that buy in now. This transition is going to be from a screen-based digital experience, so your web pages, your touch and text, to a voice and agentic experience where you wear a device like a glasses or an earbud, ask your digital assistant to do something, the AI does the rest. This is going to be a complete reimagining of how we interact digitally. And this zero UI or no screen world, it's already happening. Tell Alexa you're cold and it's going to change your thermostat. Disney's Magic Band system combining wearables and sensors personalizes your park visit and has increased guest spending by 10%, while John Deere's voice-enabled tractors let farmers control their equipment hands-free, with a 15% boost to productivity. Folks, more than 140 million US adults already use AI and voice assistants, more than 40% of the population, with 1.2 billion people globally using AI at least once a week. Now, that usage is even higher among Gen Z and millennials, with more than 7 in 10 using AI, a sign that that usage penetration is going to continue to near total we see within the internet. And I know, none of this may seem shocking because everyone talks about AI these days, but if you really think through the changes this is going to mean, this is truly mind-blowing. In fact, the seed here was an interview I saw on Yahoo Finance talking about the implications of that shift from screen-central digital experiences to a voice. I saved the interview link and wanted to play you a clip from here, and then Yahoo took down the video. But folks, this was as close to an oh shit moment as you get. That's because right now the internet runs on an ad model. You search Google or you scroll Facebook and you see those ads placed everywhere. It's how Alphabet booked $350 billion in revenue last year, and it is a multi-trillion-dollar market. Here, your attention is the commodity, harvested by the internet and then sold to advertisers. But what happens when that all changes in just a few short years? What happens when your entire digital experience is just wearing a pair of glasses with limited screen space and you ask your AI assistant to find you the best travel credit card? Your glasses or your earbuds picks up on the question and a voice coincidentally similar to Scarlett Johansson tells you the Chase Blue Opal, fills out your application, and says how great you look today. In this world, there is no screen, no ad real estate. The interface is built into cars, homes, and wearables. Suddenly, companies like Meta that thrive on that infinite scrolling and the dopamine loops, they disappear in a voice-driven world. So now the winners in this transformation are going to be those device makers with the AI integration, the AI infrastructure, and the voice assistance providers. And I found 5 stocks to buy to be ready. And the biggest winner here could be shares of Apple, ticker AAPL, which have dropped into value territory, down 7% this year. Nearly 15 years after the rollout of its voice assistant Siri, Apple has fallen behind in that race for AI, so the company is almost certainly going to need some kind of an AI acquisition, which wouldn't be a problem though with $65 billion in cash sitting on the balance sheet. One thing Apple does have though is the strongest consumer electronics brand in the world, along with all the wearables it needs to make this shift. From the Vision Pro to AirPods and the Apple Watch, Apple has the devices, the payment system, and the customers. All it needs is an AI assistant. The disappointing iPhone update cycle and slower AI development has seen Apple slow revenue growth to just 6% this year and under 5% expected next. That has seen investors flee the shares, now trading at just 8.5 times on a price-to-sales valuation, a discount to where it's traded at in the past. But this one is set up to surprise investors with an AI acquisition and the shift into this new world. Another dark horse stock here in Snap Inc., ticker SNAP, with shares down 22% just in the last year, but has a surprisingly strong opportunity in its AR Lens platform, a generative AI tool for 3D video that is years ahead in spatial development. Right now, Snap is stuck in also-ran social platform limbo with 10% revenue growth and trading for just 2.1 times on a price-to-sales basis. That valuation is based on what's really an unknown future for its main Snapchat platform, but the real future here is in this AR technology. Now, I don't think Snap goes it alone here, but instead gets bought out by another company, maybe even Apple for its lead in AI. Next up, I highlighted Spotify, ticker SPOT, last week on its trend to AI-generated music, and it could even beat that upside on this shift into voice-centric future. Spotify is an audio-centric platform, so it doesn't have to worry about losing that screen like Google or Facebook. The company is already leaning hard into its AI integration with playlists and an AI DJ, so it wouldn't be far to go to incorporate those other services with an AI assistant. And this one doesn't have the reach of Meta, but almost 700 million active users is no joke, and more importantly, nearly half of those are paying premium subscribers, so Spotify has a very valuable customer base that it can transition into that AI assistant offer. And here, my duh pick of the group is SoundHound AI, ticker SOUN, up 225% since I started recommending it in February of last year, but still with that 10x potential. SoundHound is the voice AI leader with its unique system that translates speech directly into meaning instead of having to translate into text and then meaning. It is this kind of real-time advantage that is going to make SoundHound the platform for AI assistants in cars, devices, and customer service, already working with car makers like Stellantis, Hyundai, and Fiat, as well as with drive-thru ordering at White Castle and Krispy Kreme. Revenue is expected to nearly double this year to $166 million, and while forecasts are for just 30% next year, this growth just keeps on going as the company dominates the theme. Their shares are not cheap here at 38 times on a price-to-sales basis, but that potential for the market share in a trillion-dollar market still dwarfs the company's current revenue, so this is one you just have to own. And maybe a surprise pick here with Meta Platforms, ticker META. Meta does lose that ad space on its platform, but the company has been extremely forward-thinking on wearables, now rolling out AI glasses with Ray-Ban and Oakley, along with its MetaQuest VR headset. So here, even if Meta loses that screen-centric approach for Facebook and on Instagram, it's still got more than 6 billion users across its platform that it can migrate into that voice-centric world. While shares of Meta aren't quite as cheap as Apple, trading at 10.7 times price to sales, it is still growing those sales at 3 times the pace, so well worth that premium valuation. Looking at the stocks I'm watching this week, first up, Zscaler, ticker ZS, reports earnings Tuesday night after the market close with a mixed bag for cybersecurity over the last 3 months. And this group remains my favorite growth theme, but expectations just got so high that even solid earnings reports haven't been enough, and the stocks are down lately. Here, Zscaler and Palo Alto have managed to hug the unchanged line, but CrowdStrike and Okta are down 10%, and Fortinet plunged on its report, showing enterprise customers hesitating to sign some long-term contracts. As Zscaler is expected to post 20% sales growth for the quarter, but the same weakness in earnings, down almost 10%, as that competition really erodes profits. So some of that fear is already baked into the stock. The shares are still trading expensively, though, at almost 17 times price to sales, quite a bit higher than the valuation over the last year, so I still worry about a sell-off, but would be buying on any dips. Hewlett-Packard Enterprise, ticker HPE, reports earnings Wednesday following surprising weakness in the data center outlook from both NVIDIA and Dell recently. That is not a good lead into earnings, expected to show an 18% drop in profits to 41 cents per share on a 15% sales growth for the quarter. And despite that weak news from the peers, shares are up 8% over the past month and trading relatively expensively at 0.95 times sales, so a premium to where they've been trading at over the past year. Here, I do think HPE eventually builds out a strong advantage with its Juniper Networks acquisition, but would avoid it here into earnings. Salesforce Inc., ticker CRM, also reports earnings Wednesday with shares down 23% this year and one of the opportunities of the week. And the worry is that AI tools like GPT are going to allow users to create their own software, replacing the $1.2 trillion software industry of which CRM leads. Other software providers like Workday and Adobe have also plunged this year, but earnings from other software companies like MongoDB, Pure Storage, and Snowflake just last week sent those shares up 30 and 40% and could prove that the fears are overblown. A recent study by MIT showing 95% of AI agentic programs are failing shows that companies still need these large software providers to help them transition into that AI age. Now, all this means there is a great chance we see some good results from Salesforce that back up this idea, and a sigh of relief is going to mean that stock could bounce. And here, Broadcom, ticker AVGO, which reports earnings Thursday, worries me in the same way as HPE, with the weak news lately on its data center spending. Broadcom is my favorite all-around data center stock, but after Marvell, Nvidia, and Dell reported disappointing top-line revenue and outlooks, it's clear that data center growth just isn't meeting expectations. Now, actually, it is, and Broadcom is expected to continue that 20% pace of revenue growth, but expectations are so high, and investors just want more, ever-increasing growth forecasts. With shares trading at 25 times on a price-to-sales basis, a huge premium to the valuation it's traded at in the past, this one is set up for a disappointment and a drop, even if it will still be a good long-term investment. Giving you that big picture idea here with the Sector Spider Sector Tracker, 5 of the 11 stock sectors closed higher last week, but with a little strength in any group. The energy sector rallied from oversold conditions, and as I pointed out Friday, I think oil stocks continue to do well off very attractive valuations, forecast for stronger earnings growth next year. I'm going to link to that video in the description. Check that out because it's one of the few sectors here with strong upside. Stocks in the consumer staple sector continue to lag, but that could turn around as early as this week. The sector is the second worst group this year on fears that the staples companies won't be able to pass on through the tariff costs to their consumers. With the appeals court ruling last week, I expect companies like Conagra, ticker CAG, Clorox, and Constellation Brands, ticker STZ, to rally at least over the next month or two. And remember, for any of these big picture sector level ideas, you can always go to the sector tracker on sectorspider.com and click to expand into these. You'll see all the stocks in the S&P 500 within that sector, and that's going to give you an idea of what types of companies are in these groups, as well as a few stocks to research in the theme. Updating our market outlook with less than 3 weeks to the Fed rate meeting, every report of inflation or jobs is going to carry extra weight for the market, and we see the all-important jobs report this Friday. Last month's monster revision showing just 106,000 jobs were created over 3 months shook investors' confidence, putting them on the edge to take profits. Now the CME FedWatch tool using rate futures pricing to estimate what the Fed is going to do is showing near certainty, 87% that the central bank is going to lower rates by 0.25% when it meets on the 17th, but that high inflation reported last week did lower the odds of future rate cuts, with the market now expecting just one more cut this year. This is important because nation hopes of that lower interest rates are what's keeping a lot of this bull market charging, so those hopes coming down, we're seeing more tension and more selling in stocks. Friday's report is expected to show just 75,000 jobs were created last month, but I'm expecting an upward surprise. Not necessarily a return to the job market strength over the last few years, but just a bounce off that tragically bad numbers over the last 3 months. And while that will weaken the case for more interest rate cuts, job growth is overall a good thing for stocks, so it should be a positive catalyst. Another catalyst could come Thursday when the Senate starts its nomination hearings for Stephen Moran, Trump's pick to replace Kugler, who resigned effective August 8th. And Moran's appointment, along with changes next year, moves Trump steps closer to quasi-control over the Fed and its interest rate policy. I'm not going to go all economics nerd on how dangerous this is, going down that road of Argentina and Brazil with fiscal dominance of the central bank, but Moran's testimony could help boost stocks short-term if he comes out vocally for lower rates. Join me on the community tab here on YouTube and keep the conversation going. You can add your thoughts, your stocks you're buying, or just talk investing. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.